The reason the balanced scorecard works so well is because it is balanced. That is, it balances performance reporting between financial objectives, customers, internal business processes, and learning and growth. However, balance doesn't just refer to having 4 perspectives. There is also a need for balance between qualitative and quantitative measures, financial or non-financial measures, as well as leading and lagging indicators. It is also worth noting that it doesn't necessarily matter what the perspectives are called. For example, learning and growth can also be referred to as innovation and learning. It's also important to note that the focus of each perspective can change depending on the type of organisation and its competitive strategy. The key is to make sure that everyone is in alignment, that the measures have cause and effect relevance and a link to the organisation's strategic drivers. To understand the balanced scorecard structure, picture performance improving for the perspectives cumulatively through time, starting with learning and growth, to internal business processes, to customers, and finishing with improved financial performance. What this means is that if you implement strategies or initiatives to improve learning and growth, such as employee training or new technology systems, performance in this area will improve, and it should also improve performance in other areas. Good measures in this perspective might include cross-training percentage, number of new product prototypes, number of training hours per employee, staff turnover ratio, investment dollars in new technology, and investment in research and development. Improvements in your internal business processes will follow. These are usually efficiency or productivity improvements. Efficiency improvements will result in the number or cost of inputs decreasing, and productivity improvements will result in outputs increasing. Example performance measures for this perspective include delivery time or turnaround time, quality pass rates, finished goods per day, and transactions per hour. Improvements in the internal processes lead to improvements in both the customer perspective, such as through improved service, and directly to the financial perspective, such as through reduced wastage or efficiency savings. The customer perspective measures and monitors areas that the customer sees as important and that are identified as leading to improved financial performance. Customer satisfaction, market share, number of repeat orders or new customer orders are some performance measures that you might use in the customer perspective. The financial perspective considers measures that relate to the organisation's overall financial performance. Cost-based measures may include cost of goods sold percentage and fixed costs per square metre. Revenue-based measures may include average sales per product line and total sales. Profit-based measures may include net profit after tax and operating cash flows. And return-based measures may include return on assets and return on invested capital. To recap, the balanced scorecard has 4 perspectives that are integrally linked together. Measures and performance in one perspective affect the measures and performance in the other perspectives, and all measures should link back to the organisation's strategy.